Senator Daines of Montana is recognized.
Chairman, thank you. Mr. Powell, good to have you here this morning. In Montana, as well as the Mountain West, inflation remains above 5%. In fact, we're higher than any other region in the nation, whether it's gas stations, grocery stores, increasing prices, and its real-life impacts remain truly a top-of-mind and daily issue for Montanans. With inflation remaining stubbornly high, I can't help but reflect on the warning signs that were ignored by my colleagues across the aisle while they raced to push through trillions of dollars in partisan spending disguised as COVID relief. And now the American people are bearing the brunt of this reckless spending. In fact, for the average American, unless you've received a nearly 16% pay raise over the past 2 years, you've effectively received a pay cut. Chair Powell, I urge you and the Fed to remain vigilant and steadfast in your effort to rein in inflation for the sake of all Americans. Unfortunately, record high inflation is not the only crisis the Fed is having to navigate. While bank regulators were more focused on climate change than actually regulating the banks under their supervision, several coastal banks collapsed and caused panic across the banking sector. Before the dust even settled, several of my colleagues across the aisle immediately began calling for increased regulations and greater capital requirements for banks, with little appreciation for the negative impacts these changes would have on small and mid-sized banks across the country. I've heard from community banks across Montana who are justifiably concerned that they will be wrongfully punished for the actions of a few poorly regulated and poorly managed banks. You mentioned several times in your testimony yesterday and again here today that the U.S. banks remain strong and well capitalized. Chair Powell, if banks are so well capitalized, why the urgency now to increase capital requirements that would really prevent another Silicon Valley Bank?
Well, let me say first that I think we don't have a final proposal to talk about yet. When we do, we'll be able to talk much more specifically about it. But for community banks and banks, any banks under $100 billion, I don't think they're going to be part of this proposal. So we're really talking about principally the very largest banks, the GSIBs, and to a lesser extent, the banks, the regionals, and then the banks between 100 and 250. And yes, the right question. The question is more capital the answer? And we'll be addressing that. We'll be making a proposal. We'll be soliciting public comment on that. I'm well aware that there's a trade-off here. More capital means more stable banks. It means stronger banks, but there's also a trade-off there. And with capital, you've got to make a judgment about where you draw that line.
Yeah, and to that point, increasing the capital requirements could in turn decrease lending. Will the impact this have on small businesses who may not be able to get a loan be taken into account before you finalize a proposal?
Yes. I mean, the thing is, stronger capital means banks will be able to continue to lend during difficult times too, right? So that's why we do it, is for those stressful times. But it is a judgment call, and there's a lot of science and arithmetic that goes into it. But ultimately, deciding how high to go is a challenging question. And we're going to be making a proposal, and I'll personally be listening carefully to the comments.
You alluded to focus more on the GSIBs and trying to spare the smaller banks, perhaps, from the impact. And I realize the proposal is still being developed, is not finally baked yet. But are you prepared to commit to sparing the smaller community banks from changes the Fed might propose on capital requirements?
So let me say, my understanding is that the proposal doesn't affect banks under $100 billion, and I would have serious questions as to why it would. And particularly, most community banks, for example, in your state, are much smaller than $100 billion, and I don't know why we would be looking at their capital. They're generally quite well capitalized.
Great, thank you. I'm going to turn on inflation, back to that earlier statement. I appreciate the wait-and-see approach the FMOC took at its most recent meeting. But as I noted in my remarks, inflation does remain stubbornly high, particularly in the Mountain West, and labor markets remain as tight as we've ever seen. It was noted, however, that the committee is poised to continue raising rates later this year. My final question, could you expand just a bit more on your outlook for the rest of the year and speak to your continued commitment to do whatever is necessary to bring inflation back to your 2% target?
Yes, so I think if you look at the committee's forecasts, and mine are very similar, we expect modest growth going forward, growth in the below the sort of longer run growth rate of the United States economy, which is around 2% or a little bit less, growth lower than that. And we expect the labor market to continue to gradually cool off. And with that, there's an expectation that inflation will continue to move down later this year. And if things happen that are sort of broadly in keeping with that, the strong majority of the committee believes that it will be appropriate to raise the federal funds rate again once or twice by the end of the year. A strong majority came down on twice between now and the end of the year. So I think the data will tell us what to do. I think the point of our meeting, the last meeting, was really to moderate the pace of our decision-making on this because, it was very important to move quickly last year, and we did. It's not so important now because we've come so far and we're relatively close, we think, to where we need to get. But we will, people should believe, and broadly speaking, the data show that they do believe, that we will do what it takes to get inflation down to 2% over time.
Thank you, Senator Hagerty from